Brilliant. So just to kick us off again, thanks, Patrick. A little bit about me. I'm a research fellow at the University of Leuven in Belgium, and I'm currently the principal investigator of a project called RealCli. The purpose of it is to examine real estate climate risk governance across the real estate financial system. So that means looking at things like institutional real estate investors, reinsurers, regulators, but also within 3 urban contexts: Miami, Singapore, Rotterdam, places that are, in this case, uniquely exposed to flood risk. The project entails expert stakeholder workshops, interviews with people like asset managers and planners in different places and institutions, public policy analysis, and some financial analysis. It's supported by the European Union. And today I'm going to draw on both published findings from this project and the one that preceded it, and some new insights from conversations I've been having lately. So what I want to get at more broadly are 2 sets of questions. What's at stake when we talk about real estate finance and climate risk? And what's happening in the industry to understand and manage climate risk within the real estate and financial system? How does this form of governance shape adaptation dynamics and retreat in particular? And what can we do to engage with these dynamics? Quickly, there'll be 3 parts. I'm going to set the stage and do a really quick sketch and outline of what's at stake here and why it matters. I'm going to focus on a case study in Florida involving the reinsurance sector. And then I'm going to step back and try to draw some conclusions, both about insurance in Florida and real estate more broadly. And I think there's plenty of time to ask questions and to discuss this. So I look forward to that very much. So we face what can be called a climate conundrum. Real estate's a key driver of how we create wealth in the United States and beyond, but it's exposed to a wide range of climate risks. This is a big wide world of risks, but it's uneven and it's ambiguous. We have physical risks and transition risks embedded within our financial system, and they're bound together in a wide array of combinations and contexts. So to be more specific, when we talk about real estate asset or community exposure to climate risk from an economics perspective, we're thinking about several factors, which explains risk in the sector. We have specific historical development patterns, how and where, why did we build? We have uncertain environmental processes. How are hurricanes getting stronger? What are the consequences? At what rate is sea level rise happening in a particular place? And how is it interacting with other land processes? How do we study that? How do we think long-term about that? These are conversations I'll be familiar with, that each of you will be familiar with. We have distinct land and property relationships. Land markets in Florida are very different from land markets in Singapore, and how, in particular, property law and the state shape those relationships is very, very different. And we need to think about that too. We also have wide varieties of forms of ownership and control over real estate, and how it's used, and how it's financed, and how it creates value. So is it financed by institutions? Is it mortgaged? Is it owner occupied? Is it a rental property? All sorts of interesting questions that really shape risk in the more sociological sense. And then we have emerging patterns, a patchwork of regulations and institutional responses happening all throughout the real estate finance system. So if I were going to really simply characterize what's happening here, I would say that climate risk represents a threat to business as usual within the real estate sector. We have emerging evidence coming from different corners that suggests that a combination of rising costs and declining asset values are beginning to impact what are considered high value, high risk markets, places like Miami. So might we be seeing higher costs of capital and operating expenses? For example, is a loan more expensive to get now? Are building standards being toughened, creating expenses to build? Do I have higher insurance costs every year? We also potentially see declining asset values. Are properties that are perceived to be risky worth less? Are institutions walking away from coastal property? And we might also, as a result of this, be seeing a redistribution of the costs and benefits of risk management. And I'll talk a little bit more about that in a second. What this means is that the business case for traditional investment in risky real estate regions might be eroding, and that can have consequences globally and regionally. So here's some examples of what I mean. Property reinsurers might be, they are raising premiums to reflect rising perceptions of risk. Right now in South Florida, we're seeing significant annual rate increases this year. Institutional investors are developing new portfolio management strategies to understand and manage their exposure in risky regions. In some cases, there's conversations about avoiding long-term investment in regions, conversations about disposing of assets in risky regions. We also have emerging research on mortgage markets, which suggests that banks which underwrite loans in flood-prone regions may be relying more heavily on securitization to sell on risky mortgages, to pass them on into the financial system. We're seeing stories of land speculators looking to higher elevation areas away from the flood-prone coast in ways that might both respond to but feed into declining property values. There's a great debate happening about climate gentrification in Miami, for example. We're also seeing regulators and intermediaries in the real estate system, like GRESB, set up industry-wide benchmarking processes, disclosure criterias, all of which have the potential to really accelerate both our understanding of and our response to climate risk. And it can accelerate the dynamics that I'm talking about above as awareness is heightened. So what I want to get at here is that this raises a lot of considerations beyond the real estate sector about broader patterns of economic and political interdependency. This is about, where does real estate sit in our economy? In the US economy, in the economy of our cities and our communities that we're working in, but also globally. So real estate climate risk management is going to impact things like housing ownership and affordability. In a world of declining asset values and higher costs, we need to be talking about the future of home as an asset building mechanism. How are local and regional property markets going to be transformed? Who's going to lose the most? This is as much an economic question as it is a political and sociological one of identity and attachment to place and understanding of place. We need to be thinking about labor markets. In the places where real estate and construction are big economic drivers, what happens to the job market if we see divestment or a slowdown in market conditions? We really need to think about public sector fiscal capacity. Public revenue in the United States is at the local government level often really closely connected to property markets. So how do we manage risk to property while also maintaining adequate levels of service in other ways? We also need to think about non-property financial institutions. So not just the institutions that own and invest in real estate or real estate related products like mortgage securities, but what about the financial institutions that invest in the products that those firms solve, that those firms offer? So how do declining real estate related investment opportunities locally and globally impact the financial performance and stability of, say, pension funds and life insurance companies? These are really big questions, and I can elaborate more on the scope and the magnitude of real estate investment in capital markets more broadly if people have questions about that. But needless to say, it's a really important asset class and considered a form of high value collateral in capital markets. What happens if that isn't secure? Now I want to think a little bit more particular about how some of these dynamics come together in a specific place. And I'm going to focus on one element of it. Again, lots to unpack here, but let's think about the role of reinsurance and how it relates to real estate development in Florida. And I want to start with a quote from a senior building industry executive in Florida. And he says, so far, there hasn't been much discussion about the real players in this. He's talking about resilience, the reinsurance industry. Right now, there doesn't seem to be any blowback in coastal areas. Eventually, you can have all the politics and all the plans you want, but this private sector will come to the table. If they come to the marketplace too quickly, they'll destroy value in the market, which is not the value of a resilience program, right? So the Florida story is very much one about real estate and reinsurance. There's some fundamentals to think about. For those of you who aren't Floridians, I see some in the chat box. Florida's economy is structurally dependent on real estate, and not just real estate, but real estate growth. This is because real estate has an unusually large role in the economy. So, for example, about a fifth of the US private industry GDP can be traced directly to real estate and construction. In the Miami area, we're talking closer to 30%. There's a typo there, but property tax is also unusually important in Florida because there's not an income tax. That's what it should say at the beginning. Property tax is the biggest source of revenue for local governments. And it's not at all uncommon for half of a municipality's budget to come through property tax. Florida has a unique and growing climate risk exposure. We know hurricanes are getting stronger, and we know that seas are rising. That's a problem in Florida because the real estate value and the growth of real estate markets is concentrated in coastal regions. About 80% of Florida's $4 trillion real estate market is located on the coast. Within coastal counties, that growth is concentrated very unevenly in particular places. So while there are coastal communities that are capturing property growth, at the same time that their risk exposure is growing, and there might be a balance there, there are other communities that are relatively high risk that are not seeing high rates of growth. And that's problematic for their economic futures. We also here see, the quote is just an example of the kind of unique importance of property insurance as the key financial mechanism for managing these relationships in Florida. And I think you can understand this in two ways. I think the first one is, for those of you who don't know, how does property insurance work? What are we talking about here? A quick clarification, reinsurance is insurance for insurance companies. The way that this typically works is that you can see in the diagram, a policyholder, you and me, pays a premium to an insurer every year. Those insurers generally pass on a portion of the risk in your policy onto reinsurers. And sometimes, quite often, reinsurers pass on portions of that risk further onto other institutions. And increasingly, this includes non-insurance financial institutions like pension funds. And the idea here is to transfer risk across the financial system. In exchange, this policyholder premium is supposed to, it represents a promise to pay. If there's a disaster, then these arrows flow the other way, and capital flows back to the policyholder. And that's the essence of it. To give you a sense of Florida, at the end of 2018, not including flood insurance, there were 6.1 million residential property insurance policies. $10 billion in premium was paid that year. And the total value insured residential property alone was $2.1 trillion. So this is a very big financial market. And I see some things in the chat box, and I will get to those probably easier at the end. So that's how it works. The question is why? What's the link? Why is this so important? And why in Florida? And I'll first talk kind of generally. Property insurance is what you can call a structural feature of housing markets in the US. The idea here is basically, among many things, is to de-risk the mortgage market. So any mortgage that's backed by the federal government has to have insurance coverage. That means that there's a structural link between mortgage lending and insurance markets. That makes the insurance market very big automatically. Because of that link, insurance is also underwriting risk across the set of economic and financial relationships that are linked to housing. So mortgage lending is a pipeline for mortgage securitization and investment. That is a multi-trillion-dollar asset class, for example. A a place where lots of, for example, our retirement fund goes into. Mortgage lending, mortgage affordability, the availability of mortgage capital directly underpins the stability and the growth of the housing market. The housing market feeds property values and our local fiscal capacity, so our ability to tax and offer services. It underpins real estate linked employment and industries. Like I said, think back to that GDP figure. And it increasingly, since the 1980s, we've seen housing equity increasingly play an important role in underpinning consumer spending. So we basically use our houses in the United States as cash registers if we own them, meaning that we fuel a lot of consumer spending through housing indirectly. So property insurance, particularly in the US, is sort of this infrastructure of infrastructures. It's this thing that is primarily the first line of defense in financing climate risk within our housing system and in turn our economy. That doesn't mean it's the only one, but that helps to explain why it's so big in the US in particular, and not say in the Netherlands or Singapore or other places where I do research. It's not really a factor there. The reason why it's particularly big in Florida is in part because of the amount of real estate there and the amount of real estate which is financed through mortgages. But it's also particularly important because Florida, let's just say, takes a relatively hands-off approach to climate change planning. It's a state that over the past several decades has undone a lot of its institutional capacity to regulate growth and to regulate risk. And so outside of these kind of financial relationships, the capacity to value risk, to finance risk, is sort of asymmetrically sits in the private sector versus the public sector. And that's something I can talk a little bit more about. So what can we learn from Florida? I think it's good to kind of step back a little bit, go back about 25 years to Hurricane Andrew, and to think about what happened then, because what has happened in Florida reminds me a lot of what's happening now in other places in the US and elsewhere. And I think history can be really insightful here. So it's really, the Florida story has really shaped the evolution of insurance markets and how insurers are thinking about climate risk today. So for those who don't know, Andrew made landfall in 1992 south of downtown Miami. It was at the time the costliest disaster in US history, with about $25 billion in damage. Countless lives were lost and uprooted, tens of thousands of houses destroyed, hundreds of thousands damaged. As a result of Andrew, there was a wave of insurer defaults in Florida. Companies became insolvent, and there were over $400 million of unpaid claims that were passed on to the state. Property reinsurance costs jumped in the aftermath. We saw a 68% increase year over year. Policyholder rates in high-risk coastal settings also increased as a result. A lot of the costs got passed on to policyholders. So in some areas, there were documented increases up to 200% and deductibles up to 500%. So what happened next? A lot of things happened in the aftermath of Andrew, and I'm going to try to really quickly summarize them. Inside the industry, inside the reinsurance industry, this really triggered a rethink of how risk was understood and valued. In brief, reinsurers recognized that they undervalued their exposure to hurricane risk. They weren't financially prepared for what happened. They moved from a historic way of understanding underwriting to new forms of forward-looking, probabilistic catastrophe risk models to value and manage their risk exposure. And increasingly, that pivot has applied to other what are called perils, fire, flood, risk modeling, et cetera. So it was a transformation that really changed how underwriting was done. And that's a transformation which continues today. And it's really seen a shift in the underwriting conversation inside the sector towards risk modeling companies, which are key intermediaries in defining climate risk today. After Andrew, there was also an expansion of capital flowing into the insurance space. The industry recognized that the increase in reinsurance costs after Andrew was problematic, both from a public policy perspective, but also from a financial stability perspective within the industry. So they worked to diversify the source of capital and to spread risk across a larger number of institutions and global financial networks. And they did that through forms of financial innovation. The most well-known space here is that of insurance-linked securitization, which is similar to mortgage securitization. And that brought in many tens of billions of dollars of new reinsurance capital into the industry. And Florida hurricane risk was the test case for this and continues to be the biggest asset class in this space. Another big debate was about how to keep rates affordable. If there was a problem with making insurance profitable after Andrew, there was also a question of how to avoid those big rate increases. So the state of Florida stepped up and experimented with a range of public policy measures. They created and expanded the role of the Citizens Property Insurance Company, which is an insurer of last resort, there to provide policies where the private market steps back. They got involved by creating a reinsurance institution, and took a variety of measures over the years to try to contain rates, to maintain affordability for consumers. And this was in large part responding to pressures from homeowners worried about affordability and the real estate sector, also worried about the ability to attract growth. Another big and important change was that this changed the institutional nature of the insurance business in Florida. So instead of big national insurance companies writing policies, increasingly a large part of the market was taken up by what are called specialist insurers. So they're companies that work not always, but mostly in, say, Florida. And they specialize sometimes only in hurricane insurance. And these companies, relative to larger ones, which can spread their risk across a big national or regional book of business, they rely heavily on external reinsurance to finance their business. So that means that they take a relatively greater share of the premium that they earn from their policyholders, and they spend it on reinsurance to protect themselves. So what this means is that a greater share of the Florida market was more closely integrated with the reinsurance world. And another dynamic, the last one I want to talk about, is the question of protecting growth. So after the financial crisis, you also saw the state of Florida try to boost the real estate sector. Not only did they roll back a lot of growth management provisions and reduce planning staff capacity, they also rethought their role in the insurance market. The state became a much more active proponent of reinsurance, attempted to attract more reinsurance capital to the state. It became the biggest user of innovative financial instruments to finance catastrophe risk. So, that Citizens, that company I mentioned, became the largest issuer of catastrophe bonds, for example. And as part of this process, the state took a key role in passing as much risk as possible from their own books to that of these insurers and capital markets. And that's a really big change. So, where's part two of the story? And I promise this one is quicker and simpler. After about a decade of a relatively calm period, we saw a series of hurricanes in 2017, Harvey, Irma, Maria. There's a lot to say about these storms and their significance. And I'm sorry to focus just on these economic figures, but collectively, they generated at least $92 billion in insured losses out of what was a record-breaking year for the reinsurance industry. They saw over $140 billion of losses. These figures are underestimates because for a variety of reasons, losses are still being recorded. But to give you an idea, at any one point, the global reinsurance industry has about $500 or $600 billion of coverage outstanding. So this was a very big year for the sector. The conventional wisdom would be that a loss like that would cause reinsurance rates to go up quickly to offset the losses. And it didn't quite happen. And that's a complicated story until that is COVID, which injected a lot of financial stress into capital markets. With a variety of other dynamics happening, we've begun to see reinsurance rates go up so far, about 26% this year in the US catastrophe space. And in response, these Florida insurance companies that I mentioned previously are seeking oftentimes quite dramatic rate increases, up to 30–40% annual increases. They're dropping tens of thousands of policies, and they're leaving unprofitable policies to the state, to citizens to pick back up. We still don't have a full account of the magnitude of this because the reinsurance brokering season is just finishing, and there's a lot of pending requests to increase rates, but it's something to watch. And certainly what we saw is everything that happened after Andrew in some ways is being undone again. So what does all of this mean? What does all of this granular detail amount to? So first I want to talk about reinsurance and adaptation through Florida, and I'll try to back out and think even broader. So just to recap, reinsurance is at the heart of our housing system and our economy. Florida, with its sort of unique reinsurance market, has seen waves of crisis and evolution, both in terms of public policy and capital market institutions. Attracting reinsurance capital through financial innovation has really set out to improve the resilience of property markets and to allow business as usual on coastal property, right? It's allowing, it's answering that question that a lot of people have. How is it that Florida continues to grow despite being so exposed to climate risk? And a part of the answer really depends on understanding how financial innovation in Florida in the reinsurance space has allowed rates to remain relatively stable. But after about a quarter century of experimentation, this market has become really dependent on reinsurance and these external capital market conditions. And we're seeing the potential ramifications of that now, with that capital becoming expensive or not available. What happens? Do we go back to square one? How is housing affordability impacted? Are folks covered, et cetera? What does it say about this solution to financing risk in property markets? Is it a reliable long-term response? We're also seeing right now that state, national, and international policy agendas across the board, we're seeing an almost universal proposal to expand private reinsurance as a way to manage climate risk. So we could also look to debates in California over fire and earthquake insurance. This is certainly a big part of the conversation about the reform and potential privatization of the National Flood Insurance Program. And a big part of that involves the use of private reinsurance to transfer risk from FEMA. And we're also seeing this appear in other policy recommendations. For example, in the House Select Committee on the Climate Crisis, new recommendations on how to reform the disaster financing system. Some recommendations there to try to replace disaster aid with greater use of insurance, for example. And there are, of course, many, many other examples around the world of creative insurance-based solutions to climate risk. I think that the Florida Florida story shows us that there's a really fragile balance between consumer insurance affordability, housing affordability, and private reinsurance profitability. If we look forward, the sort of endlessly increasing insurance costs, they're going to trigger affordability concerns. And they can drive property and community scale devaluation in ways that could be really inequitable. This is not just a case of wealthy coastal property owners who might not be able to afford insurance and whether or not we bail them out. And I can expand on that. This is a bit of a provocation, but there's a bit of a contradiction here, right? Insurance is designed to stabilize our housing system, but as risk increases, and that's both in terms of specific insured risks, like say hurricanes are getting stronger, but also globally, as insurers are stretched globally and they charge more for insurance, this can erode the stability and the affordability of housing markets. and the financial stability of places, risk is not somehow addressed in a more comprehensive way. I think the takeaway here is that reliance on risk transfer or insurance alone can't be, it's not a complete answer. And in itself can be a source of economic risk. It can be a driver of unmanaged retreat. Another takeaway is that I want folks to think about reinsurance as a form of adaptation finance. And maybe it's not usually thought of that way. And this is a change in mindset. In Florida alone, we're talking about $10 billion a year of residential property insurance premium, not including flood, to which you can add another billion, right? So this flow of capital has a purpose. There's a great social value to that, and there's a great reason for it. But the price and availability of that reinsurance can really vary. So when we're facing a time of scarcer public resources, when adaptation funds are scarce, I think it's time to begin to think about how we can use this existing spending and this existing financial infrastructure to mitigate the underlying risk more directly. How do we think about making properties less risky and communities less economically exposed? A lot of these ideas that I'm thinking about here come even from within the insurance industry. You can see, for example, proposals for resilience bonds as one way to address the situation. And that's certainly something to talk about more. More broadly, and I'm almost done, reinsurance isn't the only player in this story. It's not the only aspect of the real estate finance system that is responding to climate risk or relevant to the work that we're all doing. So we're beginning to see changes in industry asset investment and management practices, and they might have a systemic economic repercussion on places that are seen to be most risky. And that's the things like, labor market impacts, consumer wealth, et cetera. I would also add that financial stability, it depends on the work that happens at the local scale, and it depends on it becoming widespread. Financial institutions, say an asset investor in Chicago or Amsterdam that owns significant property in Florida, they're still trying to figure out what that risk is. And they're still trying to figure out how to value and reward adaptation work that protects that property. But despite a lot of progress in getting there, there's a lot more work to do to think about being valued, how to incentivize and align benefits, and how to make sure things like equity and more place-based considerations are part of that process. So how do we align private institutional agendas with the work that cities have to do, which is to take care of a much broader range of people. For food for thought, the Miami Climate Alliance's Housing Justice in the Face of Climate Change, I think offers a really compelling grassroots perspective to read alongside some of the research that I've cited here. I've included some references to real estate industry reports at the end of the presentation. As a takeaway, as an analytical tool to help you think about this problem, I want to highlight three kind of lenses to pull out when you read something in the newspaper about insurance or mortgage markets and climate change. The first thing is, this valuation. How we value climate risk matters. The Florida case really teaches us to think about what types of interests are at risk, what is at risk, when, where. These are very geographical questions, but the horizon on which we make underwriting assumptions has big financial repercussions. And that might seem nitty gritty, but we really need to think about how science is being applied to value risk and what types of things are being incorporated within financial modeling. And this is something that all of us who are researchers in particular need to pay attention to. Responsibility versus control. This is a big tension that comes up across my work. Responsibility for managing climate risk is distributed spatially and temporally, right? Asset managers can be based on another continent making a decision about a property. They might be thinking on different time horizons. Again, there's that question of when does future risk factor into near-term decision-making in financial industries, something that many of us will be thinking about. And this has a lot to do with how complicated real estate and finance are, and how long-term they are. How do we deal with that? How do we think about what we have perhaps control over, but not necessarily responsibility? Local governments might be responsible for trying to protect property and secure livelihoods, but do they have control over the financial relationships that really shape their decision making? That's another question. So we need to think tactically about how to connect up actors across these sort of complex institutional arrangements. And the last thing I want to highlight is just to call attention to this question of value capture. As we try to secure our real estate and our financial system and property from risk, we can create conflicts. One person's resilience dividend, right, the value they can get from reducing risk, can be a rent for another person, a risk rent. So, some folks might be able to accrue lower insurance costs by investing in, say, resilient retrofits for an asset. But that can also translate into higher rents for an occupant. There are a lot of distributional dynamics here, which are complicated in practice, that we need to begin to really tease out. And that requires thinking about how finance works in our place, because places, they vary. And as always, how do we keep equity at the heart of this? How do we imagine and understand equity in that context? So I'm gonna stop there. I think